ETBFSI.com by the Economic Times. This is Shrishti Sharma, and today we have with us Mr. Praveen Kutty, MD and CEO, DCB Bank. It's a pleasure to have you, sir.
Thank you, Srishti. Thank you for having me here.
My first question, the second pause after a 100 BPS rate cut, help me understand how are banks reacting to the current interest rate environment and the liquidity measures that have been so far, and what is the situation like? What are bankers saying? How are banks going about it?
So, in the calendar year so far, we have had 100 basis points reduction of repo rate, which we have passed on to floating rate customers. And I believe that it's a good thing, because specifically with the segment that we deal with, the small and medium enterprises, reduction of the indebtedness in that sense is very beneficial. From a bank's profitability sense, some of the actions that we've taken is that there has been reduction in the savings rate of interest, which actually happens immediately on its implementations right then and there. And also the term deposit rates have come down substantially, both for the bank as well as for the industry. You could see a deceleration in the rate of interest that's being given. Now, these are not simultaneous events, because a floating rate reduction on the loans happens at specific periods intervals, whereas the impact of the term deposit reduction depends upon the duration of the average deposits that the bank has. So I can say from our perspective, for the entire transmission or reduction of the cost of deposit to pass through, it could take somewhere between 13 to 15 months. But having said that, you're seeing the beginnings of that happening already. We've seen that in the first quarter results. So one expects the cost of fund reduction to happen in a orderly step manner fashion going forward. If there are any future rate cuts that is happening, we would see a similar kind of cycle re-emerging, where you could see a savings account rate reduction in many cases, and a gradual reduction in the term deposit rates as well. But let's understand this, NIM is not only about the rate of interest and the cost of deposit. The provision costs also apply to it, because accrual of interest is, which 90 days past due, you will do a reversal of interest happening. So having a very tight control on the NPA flows is another area which you would focus on to ensure that the NIM gap remains healthy. Apart from that, what you can't make out on the NIM, you make up through cost to income.
Right.
There's a tightening of belt. You put new holes in the belt and tighten it even further.
Okay.
And then you ride it till such time the cost of deposit catches up with the reduction of the floating rate loan interest that is being passed on. That's where we see the NIM playing out. I can't comment on whether there will be another rate cut happening. Inflation rates are looking good. But if it were to happen, you probably will see the cycle repeating.
On that note, when you speak of cost to income and the measures that can help offset the impact caused by a rate cut, did that worry you over the past few months when RBI was cutting rates back to back? What was the exact strategy in place, and do you have some control in order? In your bank already, that let's say if a rate cut happens, what will be the strategy going forward? It will be just the same cost to deposit mobilization and cost to income ratio and aspects like that. Like, what's the strategy that's been for the bank so far and ahead as well?
So we clearly focused on reduction of cost of deposit, immediacy of savings account rate reduction, a term deposit over a period of time. We looked at the cost of borrowing. We repaid borrowings which were expensive. Run a tight ship in that sense. From a cost to income perspective, we're sitting in fintech, in GFF. I can tell you some of the technologies that we have put in has really helped offset the OPEX cost. Okay. And there is increased focus on productivity. Okay. So you're trying to get more out of same, or actually more out of less. So that's the way one is moving. Last and equally important is having a tight rein on the incremental provisioning cost and the credit cost.
Okay.
because that also has an impact on the NIM. So effectively, it's about you control what you can control, right? If there is a interest yield dilution which happens through the rate cut, you compensate that through lower cost of deposit, lower cost of borrowing, uh, better control on the operating cost, and heightened focus on the provisioning norms. But let me tell you the other way around. Lower cost, lower yield also results in more throughput coming through, because
Right.
you're able to get better quality loans at a lower rate coming into the system.
Right.
So this has been, I mean, it's easy, it's simple for me to say here, but these are different lines which we ensure you rein it in and ride the wave so that NIM is maintained and helps. It just basically makes you a bit more leaner, a bit more fitter, and I hope that these lessons that you imbibe and implement now will make the bank a healthier bank in the long run.
Noted, understood. We've talked about NIM slightly. A very short question to you would be: when do we see margins for the banking industry bouncing back? The compression was there for quite a bit, sometimes for larger banks as heavy as 17 basis points. So, as an industry, when do you see margins coming back to their levels?
I mean, I would think that in Q4 you will see the uptick clearly visible,
Okay.
and then if there are no further rate cuts, which is an unknown quantity, you could see that by Q1 you should see NIMs coming back to the pre-cut rates. Anyway, the important thing here is how how soon and how fast can you pass on the rate cut through to the depositors, and that depends upon the duration of the deposits that they have.
Sure. Over to the next part of the question, that is retail composition. I mean, for quite some time, we have been seeing over leveraging in this particular part of segment for banks. What is your assessment? Do you see it peaking anytime soon? Are you seeing rising delinquencies? What is the risk that you see when you think about retail, particularly, especially as a bank that has a retail heavy portfolio?
So, as a bank, we focus on small and medium enterprises, and they constitute a very large percentage of our lending as well as our deposits. So, what I could tell you is that in this particular segment, the heartbeat of India, frankly,
Totally.
this is a segment which is vibrant. It is enormously resilient, right?
Right.
You may have a delay, but you may not have a denial. So I'm sold on this segment because it's large. It has got tremendous resilience. When things fail, and we saw that in COVID, when normal things fail, the ability of this particular base to reinvent themselves and come back stronger than ever before
Right.
is something which fills you with a lot of confidence.
Right.
So my belief is that this segment really propels the economy, and it's a very important segment. Uh, you may have delays at the lower end, but I don't see that kind of converting itself into losses in the long term. So I'm very bullish on this segment.
But any particular segments that you find, I mean, that are more risk?
You all seen what's happened with the in the MFI segment over the last
Right.
many quarters. We've seen that at the lower end of the spectrum, the smaller ticket size, we've seen a bit of a hiccup in that sense.
Right.
But frankly, the kind of customers that the bank deals with, we haven't seen a big impact of that. So at very small ticket size, whether secured or unsecured, there had been or has been a greater stress coming through. In a sense, it probably is a domino effect of what happened with MFI, which results in lesser funding coming into that particular segment, right? Higher delinquencies, lower throughput coming in, which is resulting again in a situation of a standoff, and that has impacted the lower end of the secured segment as well. But as far as normal customers are concerned, uh, it hasn't had any impact as such.
But do you see it peaking anytime soon?
I think we should be on the recovery. We've probably seen the worst of it. There'll be some tail end impact, but we probably have seen the worst of it.
Got it. I'll talk about co-lending now. The co-lending revised norms recently came in by the RBI. The industry is pretty happy about it. What is DCB Bank's take on it, and how active are you in this particular kind of partnership? How beneficial do you see it for the DCB Bank?
I'll give a bit of context on this, Srishti. So we rely heavily on two things: on partnerships and technology. So these are very big pillars for us. So
Right.
our belief is that what we can't make up with size, we can make do with very strong partnerships and superior technology.
Right.
To us, it's a leveler, right? It compensates for the lack of size, right? So in that sense, we invest very heavily in tech and in partnerships. We're non-predatory. We keep very strong, good fences make good neighbors. Philosophy is actually implemented.
Right.
Co-lending is a very important part of our offering. Almost 50%, 15% of our book is co-lending. So if you were to look at co-lending, which started in 2021, we have reached, our share of the pie is multifold higher than us as a percentage of the total banking
Got it.
spectrum. So co-lending is important for us, and I see this new rules. It will help direct more funds
Right.
to segments which are in need of funds. You could capitalize on the reach of the co-lending originator and the cost of fund benefit the co-lending partner has, and reach out to segments which either have not been reached out yet or has not been reached out in full yet. So
Right.
look forward to January 1. Let's see how the implementation of that is. So we would see a blended rate, a customer getting a blended rate of what the bank offers and what
Right.
the originator offers. It should help us get more volumes, through the door volumes, and there's clarity in the new guidelines. My guess is that this would enhance the co-lending method of lending, increase the flow, as well as lower the final rate for the customer who's availing of this.
Sure, but are there any targets for FY26 on growing the co-lending book?
We like to keep, we like to grow. We always said that we grow double a book in about 3 to 3.5 years.
Okay.
So we'd like to keep the co-lending book at about 15% of the overall lending book that we have.
So it will stay constant at 15%.
Yeah, it'll grow, but we hope to keep it at a 15% kind of level.
All right. Over to my final question.
Sure.
I'd also like to understand about fintech partnerships.
Mm.
Now that you've hinted upon how partnerships is what you're leveraging to compensate for the size, how active are you in fintech partnerships,
Okay.
and how's it faring out for you? And maybe tell us more about it.
Yeah, sure. So we could look at multiple areas where we have partnerships, and we had partnerships even before fintech became a buzzword. So pretty much early in the game. So we have launched in the GFF. We have launched a partnership with Upswing, for example, on garnering deposits. We have co-lending relationships on multiple products, on gold loan, on home loans, on loan against property, and so multiple type of loans. We have co-lending partnerships. We have on the payment side, we have DCB Remit, where you can send money under LRS, sitting in the comfort of your home, whether you have a DCB Bank account or not. We believe in open architecture. The whole idea is people come in there, try it, feel it, experience it, and if you're happy with it, you not only you explore more of DCB Bank, and you can come in that way. Right? May the best win is the philosophy that we have. So deposits, loans, payments. We have multiple partnerships running. Like I told you, co-lending book is about 15%.
Right.
We have a partnership with Neo. It's one of the it's really truly superior travel card which have launched in partnership with Neo.
Right.
Use it in multiple foreign locations, extremely competitive rates, no markup, and the customer experience of on the mobile is to be seen to be believed. You travel from India to say Sydney, stop over in Changi. The money that is loaded is seen to you in Singapore dollars. You have a variety of visa consular services which is being provided through the Neo. So whatever you can think of uh, as uh, potential problems that you may have in traveling is sorted out through this particular partnership. And the savings account of those customers are with us. It helps a bank in exploring a hitherto uncharted segment, which is high net worth salaried folks,
Sure.
which is not our core area of expertise. Self-employed is where we
Right.
go, but I can tell you, 50% of our new sourcing is coming through the this particular partnership, and you're getting high net worth salaried customers into your base. So it's a very very symbiotic relationship that we
Got
have.
it.
We provide. Let's go the other way around. Fintechs provide the UI, the UX, the slickness, the seamlessness, the speed,
Yeah.
and the intuitiveness of interaction. We provide the guardrails, the governance, and when you have these two things coming together, if you have a good idea, then we can scale to infinity, and that's the way we think about fintechs.
Noted. Over to my final question.
Sure.
What is your long-term vision for DCB Bank? Where do you see it growing?
I see.
What is it on top of your mind? Maybe when you see ending the year FY26, what checklist do you think of checking? And over a longer period, how do you envision DCB Bank?
DCB Bank is a national player. We don't have a concentration in of more than 20% in any given state. So we are very evenly distributed. Our focus is the self-employed customer, both on deposit side as well as the loan side. I believe that the self-employed customers are, I mean, there's an opportunity to be a full-fledged bank for the self-employed customer. Today, part of that is being fulfilled by an NBFC. A part of it is being done by banks which are specialized in certain locations. I think there is a space for a national player to provide all potential banking services to the self-employed customers. When you have surplus money, a particular player can help you deploy it so that you get the best of returns in a safe, effective manner with speed, with effectively giving you liquidity whenever you would want. And if you have a deficit need, and you have a deficit need at some point in time, you can lean on the same institution for meeting your deficit needs. Uh, you have a risk protection need. I mean, the inventory that you have in your store, you could have a fire, you could have a flood. I hope nothing of this happened, but these things happen. So
Right.
we distribute risk protection products through our life insurance partnerships that we have. Many of the things that our retailers sell are imported from multiple countries, and then we would love to be the partner who provides the lubricant in terms of the easing out the trade transaction when you are importing or exporting stuff.
Right.
So today, I don't think there are many full-time players who give the entire spectrum of banking services exclusively to the self-employed customers across India. And
Right.
I really am working. Me and my team are working very hard on being that particular player who would be the one-stop solution for these customers when they want, where they want, in the manner they want, and hopefully at the price they want. That's the dream we have for DCB Bank.
Sure. Thank you. That's all that I had to ask, and it was an interesting conversation, Mr. Kutty.
Thank you.
Thank you
very
for
much.
watching ETBFSI.